So, hello everyone. Over the period of time, I was reading few articles related to finance and concepts revolving around financial markets, and I came across a few very interesting terms and terminologies used in financial markets, or be it in any areas revolving around finance, which I found would be worthy of being shared to all of you who otherwise would not have known the same, because these are some terms which are used widely in the financial markets, and knowledge in any manner whatsoever manner possible helps in the best interest of all of us. So, I mean, without further ado, let's just discuss each one of them, and I hope all of you find it interesting and are able to make good use of all of these terms. So let's discuss. First word is sleeping beauty. The word sleeping beauty basically means a startup which has good and flourishing assets, but the management of the company is not very good. So these kind of startups become candidates for hostile takeovers because only the management needs to be replaced. It has all the resources which can be put in place properly, and the best can be made out of the company's operations. So such kind of a startup which has bad management but flourishing assets is referred to as sleeping beauty, and they remember it is a very good candidate for a takeover. So when probably if you become an investor in the future, you can target sleeping beauties to get good return to make good returns out of the money you invest. Next is the sushi bond. So we all know sushi is a Japanese dish, and the first thing that comes to our mind when we listen to this word and try to relate it to the financial market is something which could be related to the Japanese economy, or Japan in general. So the assumption is correct because obviously the name says it all. So sushi bonds are, bonds, if all of you do not know, I have spoken about it in my previous videos. Bonds are basically financial instruments through which companies that need funds try to raise money from the investors. And in general, they provide interest, and there could be very many different types of bonds. But talking about sushi bonds in general right now, so sushi bonds are basically bonds issued by Japanese issuers. Issuers basically means Japanese companies that try to raise funds, but these are not denominated in yen, that is the Japanese currency. They are denominated in any other currency other than yen. Now, this incentivizes for not foreign, but Japanese institutional investors in general, because there are certain restrictions that are there in the Japanese economy in which the institutional investors can only invest up to a certain threshold in foreign securities, and they have incentivized these kind of bonds because they have excluded them from being included in the threshold for investment. So Japanese investors the institutional investors can invest in these bonds without worrying about that the limit is being breached and they cannot make any further investments. The third concept is the concept of cockroach theory. The theory may be true, may not be true. So what exactly this theory is? Basically, you must be aware that the stock exchanges of various countries require the companies to report and keep as much transparency as they can in the economy by publishing correct reports so that people can read it and invest accordingly and make the correct decision while investing. So what can happen is a company that knows that it is not doing well and is trying to maintain transparency uh, would have reported something to the stock exchange through which the investors came to know that this company is not doing well. Let's take the example of New Century, the company that was there in the US subprime crisis in 2007, New Century Financial, which was a real estate investment trust. So what happened with that company was that it, through its SEC filings, it came into the picture that this company is not doing well, and so the investors tried to refrain from investing into it. Now the cockroach theory says what the cockroach theory basically says is that if a company is reporting something bad about itself, that it is not doing well, there could be instances where the company that are in the same sector are also not doing well. So, for example, there could be other real estate investment trusts that in the subprime crisis were not doing well, but they were not reporting information. But investors can make out of this cockroach theory that if this company is not doing well, the others in the sector would also not doing well, so they will refrain from investing money in that particular company. So this is basically a cockroach theory. It cannot always be true. For example, you can assume that yes, a peer cannot do well, but actually because of its good fundamentals, good management, it actually would do well. The subprime crisis in the US, it was a situation where every company had to collapse in some manner or the other. But this is just a theory. It may not be true in today's times 100% of the time. Okay, the fourth concept that we'll talk about is puke point. From the name, we all know what puke means. So in Hindi, there's a saying, "Sar ke upar pani aa." So it means that your tolerance limit and your tolerance band has been breached. You cannot take it anymore. So in stock markets or be it in any investments, when you have made a certain amount of loss beyond which you are not in a position to take more loss. I am not in a position that I can take any 1 rupee loss further from what I have incurred at this point of time. That and then you actually sell the share or the mutual fund unit or whatever you're holding. That I'm not in a position, even if it would rise, but you somewhere feel that so much loss I have incurred. There are chances that I would incur more, but I'm not in a position to bear that loss. I will sell that asset immediately right now. So that particular point where you decide to sell that asset is called the puke point, where just like how we overeat and our stomach is not able to take it anymore, the loss you're not being able to take it anymore, and you actually puke by selling the asset. So that particular concept is known as puke point. Okay. Next is the razor blade model. I think in a lot of B schools, this concept is taught to a lot of entrepreneurs, but still a lot of people would not know about this. So this is basically a type of business strategy where you make two things. You also make a razor and you also make a blade. The primary product, you sell it at a cheaper cost, and the product that is the second product that you are selling, which is dependent on the primary product, you sell it at a higher price. So for example, you are a razor company and you are making razors. You will sell the razors at a very nominal cost to the consumers, and there is only a specific type of blade that would fit in that razor, right? So that blade is also being made by you. But since the consumer cannot go to any other blade company and take blades from that company, because that will not fit in your razor, because you have designed it in such a way that no other blades would fit in it, so they will have to come to you only to buy the blades. So once you capture the razor market, then you actually try to sell the blades at a higher cost, and then you make money out of it. So this is the very prominent business strategy, and razor blade is just an example. There could be a lot of products in which you sell two dependent products, and the primary one is at a cheaper cost, and the secondary product which is dependent on it would definitely be sold at a higher cost, and you price it at a premium pricing model. So this is the razor blade model. Okay. Gazumping. So gazumping is a very prominent concept that happens regularly. We see it happening over in and out over the consumer market. I don't know how many of you would have watched the web series The Scam, which was based on Harshad Mehta's life. In that particular movie, there was a scene where Harshad Mehta actually goes to a car dealer, the Lexus car dealer, and tells him that he actually wanted a Lexus and a very good model was coming. So he offered. So he asked how much. What is the price of this particular Lexus model? So the car dealer told him that this and the price, but you cannot buy it because already I have been. It has been booked by someone else. So Harshad Mehta actually is so adamant to buy that car that he offers a good amount of money, and the car dealer is actually sells it to him instead of the person he promised it to sell it to. So by this story or the extract that I told you, understand the concept of gazumping is that basically when a seller who has already committed to a buyer to sell something at a price doesn't stick to his words when he's being offered a higher price by someone else. This is called gazumping. Interesting, right? I mean, we all know these concepts. I mean, but we do not know what it is called basically. So if somebody would come and talk to you like, this gazumping is happening, you would wonder that, I mean, what is this person talking about? But as in when I was trying to explain you what gazumping is, you could completely relate, because I mean it's a very common concept, right? But just the terminology is unique. Moving on to the next one, golden hello. So we over and over time we read articles and use that a top executive of one company left and joined another company. Have we ever pondered upon the reason how this executive was able to leave his already well settled job in one company, one top company where he was so prone with everything, and then he went to this another company? That is because of a concept called golden hello. Golden hello is nothing but trying to offer lucrative things to an executive that you want in your company, so that he can leave the other things that he's comfortable with in the previous company and joins your company. It could be in the form of a bonus, it could be in the form of other ESOP plans or incentives whatsoever, which is very lucrative, so that it is a mouth watering offer, so he cannot say no to that. And this is why it is called golden hello, that you are welcoming him with gold. him or her with gold, with the executive. The next concept is, I think this is still a common concept, suicide pill. A lot of people would have heard about it. So a suicide pill is basically, let's say, for example, a company is, you remember we discussed about Sleeping Beauty. So let's take an example of a Sleeping Beauty, which is a candidate for a hostile takeover. But that company has a lot of self-respect. It doesn't want to get, taken over by someone else. So it will try to resort to measures which by ways of which it cannot be, taken over. So what it will do is that, since it had a Sleeping Beauty has good amount of assets, what it will do is that to avoid being taken over, it will start taking a lot of debt so that it is not taken over. So this kind of company prefers not to survive, but it will not prefer to be taken over. So it is more of a self-respect kind of thing, just like a human ego kind of thing, which an artificial judicial person is also having in some way or the other. Next is the concept of a zombie debt. So a zombie debt is generally, there are different limits in different countries. There are different limits regarded for what kind of a debt could be a zombie debt. But the standard and the most, widely used meaning for a zombie debt is that a debt which is outstanding for more than 3 years. I mean, small companies that they do business, they know that, it is very difficult to recover money. It is a very common concept for them. But zombie debt, basically, if at a personal level also you give a loan to a friend, then if that debt is outstanding for a period of 3 years or more, then it is to be regarded as a zombie debt, provided that you know that since it has been outstanding for so long, there are very or negligible chances that you will be able to recover that money. So this debt has almost died. I mean, you will, not be able to recover money out of it. It has been outstanding for such a long period of time, and you're not being able to do anything also about it. So this kind of a debt is regarded as a zombie debt. So yeah, that's all for, this video. These were a few very interesting concepts and terms which I came across and I thought they were worth sharing. And I hope all of you who are watching it till the very end found it interesting. Thank you so much.